from basic support and resistance to combining trend line channels with indicators, we learned all these things. Now we will come to how the market moves, just as we have previously studied pivot points and chart patterns. Now we will study what Elliott Wave is. Elliott Wave, as we said, is the psychology of the market, human behavior. So it generates the exact same pattern over time due to human behavior and psychology instead of just reading patterns. We have to use Elliott Wave on reading the whole market trend, on reading the whole market price, because a pattern can tell us that when a double top is formed, it will go down. How far will it go? Why? How far will it go? Has the downtrend started or not? Is the top that is formed a correction, a trend change, or a reversal? Sum means all things to us. We will have to thoroughly read a market. The way to do a thorough reading is through the Elliott Wave. This was developed by Ralph Nelson Elliott, who was an accountant in the 1920 to 30. He spent 75 years of his life on this.
Kept looking only at the charts.
After looking at the charts, he said that when 66 years accumulated, he gained confidence and justified the cycle. Then he presented his data in the market and said that markets are moved on fear and greed by investor emotions. They keep repeating themselves. So he made this principle. He called it the Wave Principle. He wrote a book at the age of 66. He named it the Wave Principle. He said that the market moves based on humans, and humans are driven by fear, greed, and influenced by external factors like the news, etc. He said that we should find patterns. So the market, which seems unpredictable to us, seems unreadable, seems senseless. He developed a methodology, tested it, and proved it. He named it the Wave Principle. We nowadays call it the Elliott Wave methodology, how we are to trade using the Elliott Wave. Now, how does the market move? He had called it the Wave Principle. He said this. He said that the market always moves in waves, like if there is an uptrend, then in upward waves and in downward waves. He named these swings waves. Like right now, the price is going up, it will go down. It never goes straight upward in one direction. The price will go up, then come down, there will be a swing, then there will be a swing again. These are called waves. What does this do? This is a reflection of the collective psychological behavior in the external influence of the investor. The waves are a reflection of the investor's psychology. Now, how many waves are there? How does it happen? How can it be read? We will discuss further because this happens because of the investor himself. So these patterns repeat themselves over and over. So what do we have to do? We have to read the pattern. So what do we have to do? We have to learn to read these patterns. The more we develop the ability to read these patterns, the more we will be able to predict the future based on the present data. We have present patterns. So this will help us identify the top and bottom well. It will help us identify reversals. It will help us in predicting. This turn has happened. We will now start with the basics in which we understand the basic theory. The perspective of Elliott Wave was that it believed. It understood that the price action, the charts, the candles, they were the behavior of the price. The behavior by which the price moves, that behavior keeps repeating itself again and again, meaning that if you have an example today, the patterns you find on the monthly chart, you will also find those patterns on the daily chart. You will also find those patterns on the weekly charts. You will find those patterns on every chart for every 1 hour as well. The same patterns will be found on 5 minutes, 15 minutes, and even 1 minute. Because price is moving on behavior and human behavior is like this. It remains in the short term and also in the long term. So long-term moves are also driven by fear and greed, and short-term moves are also driven by fear and greed. So to a pyrosil, when factors repeat patterns everywhere in every time frame, is not just here. This pattern system is found in many things below as well. Now the spiral pattern in seashells will keep on repeating itself. Inside spirals you will find spirals. There are snowflakes. Inside a snowflake you will find snowflakes forming. Snowflakes are made up of more snowflakes. The same pattern is directly in lightning bolts. So this is also found in nature. The same pattern is found in price action as well. At every level, they keep on repeating themselves. This analysis helps us with multi-time frame analysis, which we will study further in analyzing on multiple time frames, in understanding the market and price and where the price has been. This is what she wants you to know in the trade. What it will do in a downtrend, how it will do it, and how far it will go. This is the basis of the theory. Price transcribe. Make it that price is a factor. It kept repeating itself in the same way at every level. Now how it repeats, what is the pattern? Now we will start discussing. Now, the most known and most used is the 5-wave structure, the 5-wave pattern. For example, a bullish trend or you have a bearish trend. What will happen in this? This will move in 5 waves. If there is a trend, for example, first we will make a higher high, then we will make a higher low, then again a higher high, then a higher low, then a higher high, meaning we will have 5 swings and we will call these swings waves. Now in this there will be trend waves. They will be wave 1, 3 and 5, and the counter trend waves will be wave 2 and 4. That is, we can call them correction waves or retracement waves. Now what has wave 1 done? When does wave 1 start? When a trend ends, it marks the end of a previous trend. But now the wave 1 is a current trend starting. For example, the market is bearish. Now the price keeps going down. The price will start to consolidate downwards. So now the price that has become bullish, the first impulse that will form, the higher high that will be made, that will be called wave 1. Okay, this will negate the previous trend. It will end the previous swing high and create a new swing high, meaning a higher high. Then after that, the second wave will come, which we will call retracement or correction. We call it wave 2. Now this wave 2 is always counter trend. For example, in wave 1, we have identified that the trend being created is a bullish trend. So wave 2 will always be a bearish move, a retracement, a correction of wave 1. But its cardinal rule, the definite rule, is that wave 2 can never be more than wave 1. That is, it can be 80%, but it can never exceed 100% of wave 1. After this, now the trend has changed. We are bearish. We made a higher high. We made a higher low. The market has started to understand. The trend is bullish. So now more participants enter the market. They get the strongest and longest move. That is called the wave 3. Everyone participates in this. Then after this, we have wave 4. Wave 4, again, just like wave 2, is a correction wave where the price comes back. After this, we have wave 4. Wave 4, like wave 2, is just a correction wave. In this, the price counter trend comes back, corrects. And why does this occur? Wave 4, because traders take profit. Wave 4 acts as an option for wave 1. Market makers decide in which direction the price will move. The trend has changed in the market. But why does wave 2 correct? Because when the previous trade was bearish, those who do not understand much thought the market was still bearish. So when wave 1 rose, they sold and entered again. The market fell again. They were in a selling mood until then, as they didn't have the capacity to read the market or understand it. But what will the market be? The market has turned bullish. So what happens to the price? The price rises again. When it rises again, they were all set on wave 3. Now the price has come down. Now more people are starting to find out. Now it is underpriced. Also, the downtrend is changing. The market is not able to touch the daily low, so everyone enters under the market higher high, then in the higher high, when the market rises and reaches wave 4. Now what did people decide? It's just a profit. So the profit remains, so we get a connection which becomes wave 4. After wave 4, the trend is bullish, the market is bullish and moves by wave 5. The participants in it are the forward traders. Those whom I call Fudukata Jose, they are the Fudukata traders. What they do is participate in the final wave. They think the market has gone bad and will remain so while the market is ending and getting ready for a reversal. So the final wave rises only because of the participation of weak-minded people and unknowledgeable people. As we discussed, wave 2 is also operative because of these people, yet it happens because of them. Now, after this, the trend will move towards correction. The corrective wave will start. This trend may change.